Yeah, let's welcome Dipan Mehta then, our first guest on the show. Dipan, hi, good morning. Broader market call. Do you think the consolidation phase for the market is going to extend for a bit more, or was yesterday a signal that the market is ready to break out and move towards new highs?
Well, I think in the immediate short term it's a bit difficult to call, but the earnings season at least seems to have begun on a right note. I think Infosys, IndusInd Bank came out with good set of numbers. Although they were disappointed with some of the mid-cap stocks like Exide Industries and CMC. But broadly, I think that this time around, we should see good numbers coming through from a whole host of industries and sectors. And that will keep a lot of investors, institutional as well as retail, interested in the markets. And some of the investment themes which we discovered in the previous quarterly season, I think should, mature into this quarterly season as well. And therefore, right now, I think at least we are focusing on what companies have to declare and what managements have to say, and whether there's an actual improvement at the ground level which is getting reflected in the corporate numbers. So my sense is that I think the markets should be steadily and positive kind of outlook, based purely on the fact that this time around too the earnings season will be quite interesting and positive.
Okay, before we ask you specific stocks, Dipan, year to date, from Jan 1st up to Jan 13th, we saw banking and other cyclicals take a beating, IT and pharma being on the upswing. So the churn was in favor of IT. Today, things are turning around a bit. What might be the theme of the rest of the month?
I think it's very difficult to call, and basically nothing has changed over the past few weeks, and I think we as well as a lot of players in the market continue to remain very overweight on the export oriented sector, and maybe that in a way is a risk, because if the results are not up to street expectations, then one could see a correction as we have seen in CMC today. But broadly, I think if you look at 6 to 12 months, I think the export oriented companies in the software and the pharma industries should deliver very good returns for shareholders. And then maybe we could look at private sector banks as well as the NBFCs, where we are still seeing that secular momentum is being maintained. And maybe a couple of more sectors could surprise this time around as well, maybe the likes of capital goods or metals or something, because this entire rupee depreciation which has taken place in the September quarter, we saw part benefit of it in the September quarter results, but a lot of it will flow through in the October to December quarter as well. So, I mean, on the whole, it does appear that some of the sectors which did well in 2013 may continue to do well in 2014, and maybe a few more sectors may, come out of the woods and, show interesting trends, show some promise going forward.
All right. Dipan, your point on CMC is well taken, and in that case, would stocks like TCS2 be prone to a bit of profit booking correction? We've already seen a bit of that today, but given the kind of rally that we have seen, and TCS is not an inexpensive stock like some of its peers are, would there be a bit of worry?
Yeah, absolutely. I think, as I said, that's one of the risk factors, that at least this earnings season we are entering with a lot of hope and expectations. Prices have rallied into this particular earnings releases, and a lot of the IT companies, pharma companies have done exceedingly well over the past 3 months. In fact, the appreciation in these stocks started around the last earnings season, and they have moved up significantly across the board by anywhere from 20% to 70% as we have seen. And that in itself is a bit of a risk factor, because when the earnings do come out, that sell-on news kind of syndrome does take over, and you could see minor selling taking place at that point of time. I think from a long-term investor viewpoint, these declines could be opportunities to again add exposure to these stocks, because I think basically till the election results are known, I think the biggest theme has to be the export-oriented companies. They're benefiting from improvement in global trends. They're benefiting from a weak rupee, and as against that, I think we have seen a very dismal set of industrial production numbers, which means that at the ground level, I think domestically, I think things are not improving as much as we would like it to. Even on the capex side, I think the cycle is still yet to pick up. So the only horse which investors would like to ride at this point of time are the export-oriented sectors. And over there, I think, there'll be a churn within the sectors. I think if CMC did badly this quarter, then, some other stocks, maybe underperformers of the previous quarter, may turn around. So that kind of a churn will continue to take place within the pharma and the IT industry. But one would say that there are enough opportunities within these sectors for investors to, deploy their money in a profitable manner, and at least get returns, which are in line with what the index will give, or maybe even slightly higher.
Dipan, I don't know if you pondered on this much, but why did the CMC shares fall so much? A flat quarter on quarter in a quarter which is usually bad because of furloughs is such bad news for the market?
No, I think that, we like to look at CMC on a year-on-year basis, and this quarter has been amongst the slower quarters as compared to what we have seen over the earlier 2 quarters. So that's the reason why we are seeing this kind of a sell-off. Also, liquidity is low in the stock given its shareholding pattern, and at the same time the stock had run up significantly. So we are seeing this kind of sell-off taking place. But I don't think that the long-term, promise or long-term fundamentals of the company have changed in this one particular quarter. It still remains to be it still is quite encouraging, given all the various challenges. And the peculiar nature of the business is such that, typically they have 2-3 flat quarters, and then there's a step up, depending upon what projects come on stream, depending upon what orders, actually get into execution mode. So there's a slight difference in CMC and some of the other mid-cap IT companies. The business model is slightly different. So to an extent, there's a degree of volatility in CMC's earnings, which may not be there in some of the large and mid-cap IT stocks. And we've been prepared for such numbers, and such kind of situations could arise. But as long-term investors, I think CMC will deliver returns in excess of its peer group at least.
Dipan, the stock that flatters to receive a lot of time is ONGC. Again, it was one of the big winners yesterday, but has given up more than half of those gains in today's trade. How would you approach this one?
I think, over a period of time, we stopped analyzing and following these oil companies. No doubt they are really huge in terms of market cap. But, if you hit a wall when analyzing these companies, because one doesn't really know how the subsidy mechanism is going to play out. My sense is that the good times for the oil marketing companies will start if oil prices actually come down. And what we are seeing is that a lot of analysts globally have become very bearish on crude oil, and there are several fundamental reasons for it, right from Iran oil coming on the market to Libyan ports opening up, and there of course is that shale oil phenomena which is taking place in the US. So there are a few estimates suggesting that crude oil WTI could fall to as low as the 80s, and that could be a game changer for the oil marketing companies, irrespective of what the government's pricing policy is for finished products. So until we reach a situation where there's the subsidy problem is solved once and for all, I think the oil marketing companies could be avoided. But I think we are reaching that stage pretty soon, and one needs to have a closer watch on the oil market and what the oil marketing companies and ONGC could deliver going forward.
Fair point, Dipan. Thanks a lot for joining us on that slight